What's up? Today I'll be talking about how to prepare an investment portfolio for a market crash. We'll talk a little bit about the history and frequency of market crashes, and then we'll take a step-by-step approach on how to build a portfolio that not only allows us to withstand a crash, but actually capitalize on a crash and come out on top. I want to respect everyone's time, so I want to be clear on not only what this video is, but also what it is not. This video is not me speculating on whether or not I think there will be a crash, or me predicting that there will be a crash. This video is not me saying that I know when to sell out, short the market, and buy back lower. I can tell you that there will 100% be a crash at some point. That's just how life works, but I can't say exactly when and how long it will last. So I'm humble enough to recognize that I'm not psychic, I can't predict the future, and even most experts fail in predicting short-term moves in the market. Anyone that follows financial media knows that there's always some investors predicting a market crash at pretty much all times. But like they say, even a broken clock is right twice a day. We tend to remember and hail these predictions come true, but we tend to forget about the many that were wrong when the market continues to rally. After all, the market is up roughly 8 out of every 10 years, so in the long run it really does favor the bulls, and it can be costly to be a perma bear. But to get back on topic, this video is really for the average investor. It's about understanding market downturns and tailoring an appropriate investing strategy and portfolio for an investor's own individual risk tolerance before the downturn takes place. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, feel free to lurk down below and check out the links in the description. You can get free stocks, free crypto, cash back on purchases, and other fun stuff. So without further ado, let's get started. So let's look at some definitions. A market crash is a sudden and very sharp drop in stock prices, often on a single day or week. A stock market correction is defined as a market decline of 10 to 20%, so you can't really define it as a correction until after it's officially over. A correction is more severe than a dip, which is only a brief downturn from a sustained longer-term uptrend. Market corrections are very common and occur roughly once every 1 to 2 years. The market can be incredibly emotional and tends to overshoot to both the upside and to the downside in the short term. A bear market is a market decline of 20% or more over a sustained period of time, typically 2 months or more. Bear markets occur roughly once every 4 years. The good news is that bear markets are typically measured in months, while bull markets are measured in years. The average length of a bear market is 9.6 months. That's significantly shorter than the average length of a bull market, which is 2.7 years. Stocks lose 36% on average in a bear market. However, stocks gain 114% on average during a bull market. Additionally, half the S&P 500's strongest days in the last 20 years have technically occurred during a bear market. So you see why it's so important to have an investing strategy that not only allows you to withstand the bear market, but also allows you to stay in the game and capitalize on those strong days coming out of the bear market. After all, every bear market in US history has been erased by a subsequent bull market. So if the investing portfolio is diversified and the time frame is measured in years, no correction or crash is really a concern. Bear markets can be some of the best buying opportunities. So let's get to it. The first step is to have your deductibles covered and to have a 3 to 6 month emergency fund and cash reserves. Even before this is having a budget and understanding how much money is going in and out. Many people use services such as Mint by Intuit to track spending. It goes without saying that high interest debt should be eliminated in this step. Credit card interest can be as high as 35%. Credit card debt has got to go before investing, because you can't realistically expect to make a higher return in the market than the interest rate of the credit card. And even if you did, you would have to assume risk to do so. High interest debt is compound interest working against us, and it's got to go. So I understand that this is an incredibly boring step, and keeping cash reserves is borderline cringeworthy as savings accounts are paying pathetic amounts of interest right now. But bear markets are often accompanied by economic recessions where many people lose their jobs. If these people do not have emergency reserves, they may end up having to sell their stocks at the bottom of the market to cover their expenses. So you never ever want to be a forced seller. Not only are they eating a fat loss, but they're unable to capitalize on the stock market sale that is occurring. It's also important to have a good savings rate, preferably 20 to 25% or more. If times are good and we are still living paycheck to paycheck, it is only going to get worse when a recession hits. People make the dumbest decisions of their life when they are desperate. You never want to be desperate, so most people store savings in something that is liquid, accessible, and close to zero risk, like a high-yield savings account. However, I can link in the description to a video I did where I explore other options to earn higher yield on savings, such as stablecoin yield, which can be as high as 8 to 10%. Granted, while this may be stable and low risk, it is certainly not zero risk, so that's something to consider. But I want to be clear, while it's possible to keep too little cash, it is also possible to keep too much cash. Many people live their lives in fear of a potential stock market crash to the point that they never invest or they don't invest enough. The average savings account rate is currently paying 0.06%. The average 1-year CD currently still only pays 0.014%. Meanwhile, inflation averages 2% a year, and the current year-over-year inflation rate is 7%. Choosing to hoard excess cash is essentially accepting a guaranteed loss of purchasing power. Choosing to invest in the market can be volatile in the short term, but is a reliable generator of wealth in the long term. Think of it like yo-yoing while walking up a hill. Day to day, month to month can be up and down, but the long-term trend is upwards. The next step is to understand your risk tolerance. It is easy to forget about risk in a bull market when everyone is happy and everything is going to the moon. But when a bear market hits, you tend to find out just how much risk you were taking, and by then it can be too late. Kind of like when the tide goes out and you find out who is swimming without a bathing suit on. So the general rule is this: the younger you are, the more risk you can afford to take, because you have more time to recover from a downturn. The older you are, the less risk you can afford to take, because older individuals have less time to recover from a market downturn. Therefore, retirees tend to focus more on safe and stable income-producing assets, as opposed to those that seek aggressive capital accumulation at the cost of higher risk. This is essentially transitioning from the wealth accumulation phase to the wealth preservation phase. Target date retirement funds automatically de-risk over time without the investor having to lift a finger. All they have to do is choose the fund that corresponds with when they want to retire. The fund will start off mostly in stocks, and then will transition more to bonds and fixed income as they approach the retirement date. The same de-risking principle applies for investors that know they will need the money at a certain date, like saving for a kid's college fund in a 529 plan. Additionally, those with higher net worths and disposable incomes can afford to take more risk regardless of age, because they have much more cushion should there be a downturn. This chart gives us an idea of what a conservative portfolio looks like compared to an aggressive portfolio, and also everything in between the two extremes. However, I tend to disagree with the percentage of bonds in a typical, air quote, aggressive portfolio. I don't feel as though they have any place in an aggressive portfolio at all. But again, everyone has their own risk tolerance and their own definition of aggressiveness. Many people use the classic your age in bonds rule. So for example, a 20-year-old would have 20% in bonds. Or some people would do age minus 10. I just feel as though this is really wasting the years where the opportunity cost of your money is the highest. And at that age, you can really take advantage of the power of compounding. A 20-year-old can have an 88x multiplier on their money just because of the amount of time they have in the market and the risk they can afford to take. This pyramid is a good way for us to visualize and categorize risk. We see the saving accounts, CDs, and U.S. Treasury bills down in the lower risk category. Moving up, we see U.S. Treasury bonds and then blue chip stocks in the limited risk category. In the moderate risk category, we have mutual funds, small caps, and growth stocks. At the top of the risk pyramid, we see stuff like options. You could probably throw blue chip cryptos into the moderate risk category and the more speculative altcoins in the higher risk category. And just because younger people can afford to take more risk doesn't mean that they should venture out into extremely speculative areas and take excess risk. But risk also depends not just on the investment, but also on the size of the position as well, in proportion to the overall portfolio. The average investor probably shouldn't mess with options, buy on margin, or really use any form of leverage. Beyond age and net worth, it also depends on how much volatility an investor can stomach. For that reason, it is very important for investors to have a general understanding of the best and worst case scenarios and expected volatility of what they choose to own. Not everyone can handle watching their portfolio swing up and down 20% every day. Crypto investors know what I mean. If an investor is not at peace with what a bad day, week, or month looks like in their portfolio, they could end up panic selling and paper handing at just the wrong time. Additionally, it's incredibly important to understand your investment and understand your why. Anytime I buy an investment, I simply ask myself, why am I making this investment? And the answer can't be because the price is going up. Because then what happens when it's not going up? I'll also ask myself, if the price went down 10% tomorrow, would I regret my decision and want to sell? Or would I want to buy more on the dip? If I can't give the correct answers to both of these questions, I probably don't have any business making that investment in the first place. The more due diligence you do, the more you will understand the value of your investment and will therefore be less likely to panic sell when the market crashes. But no matter how much due diligence you do, you can always be wrong, which brings us to our next point, diversification. Diversification is protection from making mistakes. Concentration in any one stock or asset is how you can build extreme wealth. Just ask the people who went all in on Bitcoin. But concentration is also how you can get completely wrecked, just like all the people that aped all their money into the squid token.
Dollars. And now the market, oh! Oh! It went to zero! Yo!
A diversified portfolio will rebound from a market crash given enough time. You just can't say the same for a portfolio that is concentrated in just a few stocks or assets. For instance, if you bought Cisco stock at the height of the dot-com bubble in 2000, you would still be down on your money. If you bought the S&P 500 at the same time in 2000, you would be up 3x on your investment. and that is buying at the literal worst time imaginable. But this brings us to our next point, dollar cost averaging. The previous example shows a one-time purchase of stocks. Dollar cost averaging is an investment strategy where an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. This removes the stress of market timing and prevents investors from going all in at the absolute worst time possible. Some of these purchases will turn out to be less than optimal, some of them will turn out to be great buys when the market is low. Dollar cost averaging also prevents an investor from hoarding cash and waiting for just the right time to invest. For instance, if you were waiting for the market to go lower in 2009 to deploy some capital, well, you might have been waiting for a while because you would have missed out on a 10-year bull market. That's why they say time in the market beats timing the market. If you missed the 10 best days in the S&P 500 from 1998 to 2017, you missed out on 67% of potential investment returns. Given that the market is up 8 out of every 10 years, usually the best time for an investor to invest is as soon as they get the money. Like they say, the best time to invest is yesterday. The second best time to invest is today. This is why automated investing is so powerful. Money just comes straight out of your paycheck every week, 2 weeks, month, or whatever, and just gets automatically invested without the investor even having to think about it. Honestly, automating investments into a broad market fund and forgetting about it is not only easy, but also incredibly effective. A Fidelity study once showed that the investors that had the best returns were either investors that forgot about their account or investors that were dead. Think about it. Dead people don't try to time the market. They don't trade. They don't paper hand when the market goes down. Dead people are the ultimate buy and hold diamond hand investors. So we don't necessarily got to die, but we can certainly learn something from the dead investors. Additionally, when the market goes down, investors in a taxable account have the opportunity to tax loss harvest their positions. Tax loss harvesting is the selling of securities at a loss to offset a capital gains tax liability. Investors can sell at a loss and buy an investment that is not, air quote, substantially identical to the one that they just sold at a loss. Or they can choose to wait more than 30 days and repurchase the same investment that they initially sold. Repurchasing the initial investment within 30 days is deemed to be a wash sale, and therefore investors cannot claim the loss. Along the same lines, a market downturn can also be a good time to convert a traditional IRA to a Roth IRA, if an investor is looking to do that. With a Roth IRA, you contribute after-tax dollars. Your money grows tax-free, and you can make tax and penalty-free withdrawals after age 59.5. With a traditional IRA, you contribute pre-tax dollars. Your money grows tax-deferred, and withdrawals are taxed as current income after age 59.5. So making this Roth conversion effectively reduces the amount of the conversion and thus the taxable income that the investor has to declare. So what are my thoughts on preparing for a market crash? My approach is simple. I dollar cost average into a diversified portfolio of stocks and crypto, and that is it. I'm young, I keep a long-term time horizon with all of my investments. We're talking about decades. I don't buy anything that I wouldn't be comfortable holding through a bear market. Because I have a long-term time horizon, I don't shy away from risk. But I also don't take excessive risk on extremely speculative investments. I don't try to time the market, but if I do see the market take a good dip, I will throw some extra money at it. This is a very easy and low-stress way to invest. Because it is really just buying and holding, it's pretty tax efficient too. Bear markets will come and go, but because I have a long-term time horizon and a diversified portfolio tailored to my own individual risk tolerance, I really don't concern myself with it. But if you found this helpful, consider hitting the like button and subscribe for more content like this. Again, also consider checking out the links down below. Currently down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, $50 with Bitcoin with Celsius, where you can earn interest on your crypto holdings, and also $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and I'll see you in the next video.